And then I started really recommending silver too, which I think is now just starting to move. Yeah. I would not be surprised to see $100 silver next year. And, so that's a triple from here. I don't think gold's going to triple in the next year. I mean, it could, but if it just goes up 50%, you're talking about like $5,000 gold. Right. But $5,000 gold and $200 silver would be what, 50 to 1, which is still not even that expensive for silver. It's still kind of cheap, I think. Yeah. We were at 100 to 1 a couple of weeks ago. Yeah. And now we're about 90 to 1. So
the precious metals market is experiencing a dramatic resurgence, with silver leading the charge, reaching its highest level in 13 years. This significant breakout represents the strongest performance for silver since its historic run to $50 during the 2011 to 2012 bull market cycle, signaling what many analysts believe could be the beginning of a new precious metals supercycle. Prominent economist and investor Peter Schiff, known for his bearish outlook on the U.S. economy and long-standing advocacy for precious metals, has become increasingly bullish on silver's prospects. Schiff believes silver is just beginning its upward trajectory and boldly predicts it could reach $100 per ounce as early as next year, a potential threefold increase from current levels. His forecast is driven by strong fundamentals and rising investor interest. While this is an aggressive timeline, broader market sentiment also supports the possibility of $100 silver, with many analysts viewing it as a realistic scenario over the next 10 to 15 years. While Schiff acknowledges that gold may not experience the same dramatic percentage gains as silver, he still sees substantial upside potential for the yellow metal. He projects that gold could rise 50% to reach $5,000 per ounce, driven by a combination of factors including continued central bank purchases and escalating global trade tensions. Industry analysts share similar sentiment, with many forecasting that central bank gold buying and geopolitical uncertainties will propel bullion prices toward the $5,000 mark by 2028. Before we dive in, please take a moment to like and share the video with your friends and fellow investors. Don't forget to subscribe and tap the notification bell so you're always up to date. Your continued support helps this community grow stronger every day.
Because the gold mining companies own gold, right? They have it, but it's still in the ground. They just haven't dug it up yet. But that below ground gold was trading historically cheap relative to what it's worth after you dig it up. Yeah. And so it seemed to me like, well, if you didn't buy $2,000 gold, now it's $3,300. You can buy gold mining stocks that are the same price as they were when gold was 2,000. It's like that move never even happened. Right. But they're going to catch up. And I think people are going to look back who didn't buy these stocks and how could I have not done this? Right. There's an investment, a no-brainer, but sometimes the no-brainers aren't obvious until hindsight. Right. And you look back and you say, gee, how could I have been so dumb? Why didn't I buy that? And so I was really trying to get even a lot of our clients at Schiff Gold to say, hey, you've been buying gold from me for 10, 15 years. Buy gold mining stocks now, because this is, yes, gold's going to keep going up, but you can get much better buy on the stocks. You make more money. And then I started really recommending silver too, which I think is now just starting to move. Yeah. I would not be surprised to see $100 silver next year. And, so that's a triple from here. I don't think gold's going to triple in the next year. I mean, it could, but if it just goes up 50%, you're talking about like $5,000 gold. Right. But $5,000 gold and $200 silver would be what, 50 to 1, which is still not even that expensive for silver. It's still kind of cheap, I think. Yeah. We were at 100 to 1 a couple of weeks ago. Yeah. And now we're about 90 to 1. But, when you buy gold mining stocks, of course, the assets that the gold mines have is the gold that they're mining. Yeah. So you're still buying gold. You're just buying it below ground.
Earlier in the process.
Yeah. And then, they pull it out of the ground and then they sell it. And most mining companies now, the big ones, their cost of mining gold is around $1,400, $1,500, $1,600 an ounce. But as soon as they get it out of the ground and they're selling it for $3,400 an ounce, that's a good business. Yeah. And it's going to get better because the price of gold is going to keep going up, I think, more than the cost of pulling it out of the ground. That wasn't the case for a long time. Gold prices were rising slower than the cost of mining. Right. So even though gold was going up, and people who own physical gold were doing really well, most mining stocks were not seeing the benefit. But now they are, but they're not priced for it. People are still pricing gold as if that gold mining stocks, as if that dynamic hasn't changed. That's why I came up with a special report on my Europac website, europac.com, the best way to buy gold, which was gold stocks. And since that report's come out, I mean, the stocks are probably up 30%, 40%.
Yeah.
So that they're outperforming gold, but they still have a ways to go. I mean, I recommend that people have both, that they have some physical gold, but as an investment, they buy these gold mining stocks, and they also pay dividends. So it's not like, you don't get any dividend on your physical gold, but you will get dividends on most of the mining stocks, and they're going to be raising their dividends because their cash flow is just soaring because of their earnings. Treasuries are going down. They're not getting a safe haven bid. The dollar did rise slightly, but only off of a 3-year low that it hit yesterday. So it's barely up. It's gold that is getting the safe haven money. Of course, Bitcoin, fool's gold, is down too with the NASDAQ and the stock market. But the fact that U.S. dollars and U.S. treasuries are not the safe haven is a game changer for not only investors, but for Americans with our standard of living, because the days of, coasting on the dollar's reserve status are over. And we're going to see a significant increase in consumer prices and interest rates over time and weakness in our financial markets. And so we're going to be seeing a rising cost of living, but our assets are going to be going down. The opposite of what we had before, where stocks and bonds or real estate were going up and prices were kind of held in check. All this is going to reverse.
Economist Peter Schiff argues the U.S. economy has likely been in recession for some time, contributing to Donald Trump's election victory as voters responded to underlying economic pressures. This assessment aligns with forecasts predicting a formal slowdown beginning in the fourth quarter of 2025. The projected downturn appears severe and prolonged. Bond market turmoil and austere fiscal policy are expected to drive the U.S. into recession by late 2025, with real GDP not recovering to pre-recession levels until early 2027. All economic sectors are expected to face substantial declines throughout 2026, indicating a broad-based contraction that will affect employment, corporate earnings, and consumer spending. As economic conditions deteriorate and recessionary indicators become more apparent, Schiff anticipates the Federal Reserve will reverse its current monetary policy. He expects that rising unemployment or declining payrolls will prompt the Fed to cut interest rates, with officials arguing that economic weakness will help dampen inflation. This policy reversal would mark a significant shift from the Fed's recent focus on combating inflation through higher rates, demonstrating how rapidly changing economic conditions can force central banks to adapt their strategies to address new challenges. Let's get back to the video.
Yeah, oil was at like 73, 74, and that's over a 30% move from where it was 3 weeks ago. So it's a pretty big move because a lot of people were hanging their hopes on falling oil prices for rate cuts and lower inflation. And, that's gone because oil's headed higher. But gold almost hit a new all-time high overnight. It came probably within $10 or $20. Yeah. But I think it could have its highest close ever. I think when I stopped looking at it, it was around 34.50. Yeah. But last week we got the breakout in silver, where not only did it get above 35, it got above 36, almost hit 37. Yeah. And right now we're still 36 and change on silver. Gold stocks hit 52-week highs today. The GDX hit a 52-week high. And I think significantly, both Newmont and Barrick, which had been two of the stocks that hadn't made new highs, finally did that today. Yeah. In fact, Barrick hit its highest level since 2012. But those stocks have been very cheap for a while. It's been some of the mid-tier companies that have really stolen the show recently with bigger moves. But now you're seeing this, move in the biggest ones, which to me shows more institutional money looking for size coming into those stocks. And so, this is going to be a bigger move than what we've seen so far. But what's really significant about it, I'm going to talk about this, today, is the fact that we've had this, geopolitical event. We got missiles, going up back and forth now between Israel and Iran. But the problem initially is the Fed starts printing money to buy bonds to keep interest rates from rising. Yeah. But the more money the Fed prints to buy bonds, the more inflation the Fed creates, the less attractive the bonds become. And so now more people wanted to sell them. And now they have to print more money to buy those, which makes inflation worse, which pushes more downward pressure. So the more they try to prop up the bond market by creating inflation, the more downward pressure they put up on the market they're trying to prop up. And then it's not just treasuries, because once the inflation is really out of the bag, Well, corporate yields start to go up, municipal bonds. So now what is the Fed going to do? Oh, we're going to start buying muni bonds. We're going to start buying corporate bonds. Well, that's even more inflation. So the Fed destroys the bond market in its attempt to save it. And then you just potentially have hyperinflation. But at some point, the Fed has to say, all right, we're not doing this anymore, right? Then you have the Armageddon. But if you don't avoid it, you actually make it worse. Because if you take it to the nth degree and you never stop, then you destroy the currency completely and you have hyperinflation. And there's nothing worse than that. So sometimes that happens because the only way to stop it from happening means something really bad has to happen. And so instead of having something really bad happen, we have something even worse happen later, right? That's the political trade-off that seems to get made.
During a recession, global stock markets typically decline as economic downturns weaken business performance, prompting investors to exit the equities market. This shift often drives capital toward physical safe haven assets, such as gold and silver. Historically, gold has performed well during such periods, frequently showing significant price growth. On June 17, Ottavio Tavi Costa tweeted that silver is on the verge of a significant breakout, citing what he describes as one of the longest cup and handle formations he has ever seen, a classic bullish technical pattern. Then, on June 26, he followed up with a brief but assertive tweet. It's time, signaling his conviction that the breakout is imminent. Could silver be entering a new bull phase with the potential to lead the precious metals rally? Share your thoughts in the comments. If you enjoyed this video, don't forget to like, share, and subscribe. Your support helps us keep delivering the latest market analysis to you and the entire community.